On the Express this week, a U.S.-European trade deal. Who are the winners and the losers? Higher highs for stocks, and the rally is cyclical. It's meme stock madness, but it's 2025 style. Very different this time around. Cameron Dawson of NewEdge Wealth helps us make sense of it all, and it's short season again. Someone is getting squeezed. Plus, the Investopedia indicator and what to watch this week. From New Mexico to Wall Street on the tracks of success, lean back and ride low on the Investopedia Express. Welcome back and welcome aboard. This is the Investopedia Express, and we are not live from the New York Stock Exchange. We're in Santa Fe, New Mexico, my hometown. Coming here to visit the family for a few days. A little bit different than the floor of the exchange, but this is how we roll out here in the 505. Riding low, keeping it high, and riding real smooth down Highway 5 right here in New Mexico. Route 66 passing through the great state of New Mexico. This is where I grew up. Good to be back here. Good to be joining you again on the Investopedia Express. Thanks so much for joining us here live. This, again, posts on demand on your favorite podcast networks after the show. Make sure you are commenting. Make sure you're giving us your thoughts. We'd love to hear from you. And we are glad to be with you. And wow, higher highs here again for the stock market. And we got a trade deal, U.S. and Europe reaching a trade deal over the weekend. Here are some of the details from it. 15% tariffs on most European goods, including cars. That threat was 30%. You remember, the United States was threatening 30% tariffs on European goods if we didn't reach a trade deal. Well, we did over the weekend. The President Trump talking with Ursula von der Leyen, talking about how this is a good deal for both countries. Well, depends where you're sitting and which country you're in. But not only is it 15% tariffs, and with some exemptions, those exemptions are for chemicals and pharmaceuticals, two of the biggest key imports. Hello, Chef Crown. Two of the biggest imports from Europe that we depend on here in the United States. But Europe also agreeing to $750 billion worth of energy purchases. Let's go. And $600 billion in investments, including in high tech and in other sectors. So that's a pretty good deal for the U.S. They're going to buy some more equipment, some military equipment from the U.S. And this is how these trade deals are starting to shape up. If you've been watching closely, look at Japan, look at South Korea. They get a reduction in the threatened tariff levels, and they promise to make some investments here in the U.S. Now, what are the big bogeys out there? China and the U.S. still haven't reached a trade deal, but we know officials met over the weekend in Sweden to try to hammer one out. It'll probably be some combination of opening up the Chinese consumer market to U.S. products and U.S. companies, but also we want those rare earth magnets here in the U.S. So we're going to hear a lot more of that, and I bet you August 1st won't be the deadline on that trade negotiation. We'll probably see that kicked into the fall as those countries are intending to meet, the U.S. and China, in potentially Korea sometime this fall to hammer out a bigger deal. Hey, Max Dio, this is awesome. How often do you do these? Every Monday at 10 a.m. we are live. The Investopedia Express is coming to you, but we're also on demand on your favorite podcast network. So thanks for chiming in. Let's take a quick look at some headlines across the great pages of Investopedia.com, my favorite website. And of course, they were talking about the U.S.-European trade deal. We're talking about how baseline tariffs are what we should expect now and what we should expect to pay as consumers. We're also looking at the big earnings coming out this week. It is a massive week, not just for tariff negotiations with that August 1st deadline, but corporate earnings. We are in the thick of it. We're going to hear from some of the biggest companies in the market this week, and earnings been better than expected, but that's usually the way things go. We got some previews there. Also looking at Intel's plans to split up the company. Breaking up is hard to do, especially in the chip business. We'll see if that goes through, but we are at higher highs. Stocks, again, following the trend to higher highs, and these tariff deals only add fuel to the fire, and that's why we're seeing yet new highs again, 10 new record highs so far this year. Remember, last year, we were close to around 55, and guess what? Breadth has been pretty good. It's not just a few stocks making new highs. It's not this concentration of the mega cap techs that we've seen before. We're seeing a pretty good cross-sector rally here, and we're seeing it in cyclical stocks. What are cyclical stocks? Cyclical stocks, according to my favorite website and your favorite website, those are stocks that sort of track the progress of the economy. And we're talking about industrials, we're talking about financials, we're talking about consumer discretionary, we're talking about tech. And if the economy is strong and getting healthier, these stocks, these sectors should rally with it. And we're seeing pretty good breadth across them. Let's look at a few of the ETFs that represent that. The S&P 500 up a little better than 15% so far since in the past 3 months. But look at XLY. This is a big consumer discretionary ETF that's up 13%. XLI, the industrial ETF brought to you by the good people at State Street Global Advisors. That's up 20%. And XLF, that's the financials. When you see a rally in financials, industrials, consumer discretionary, that tells you that this trend is pretty strong right now. Again, this is not just a concentration of Palantir and Nvidia and Meta and the biggest tech stocks out there. Cross sector rally. Staples value stocks really haven't caught back up again, but they led the market when the market was in trouble. But this is what you would expect when there's a lot of enthusiasm around these trade deals, and when you get potentially better news around deregulation, right? We may get some Fed rate cuts coming up here. If there's enough pressure put on the Fed, those will probably come this fall. So, as we say, both on Wall Street and here on Camino de la Cruz Blanca here in Santa Fe, New Mexico, the trend is your friend. Don't fight it when stocks are rallying. But you know what? We've also seen some of the best performing stocks in the market since so-called Liberation Day. Well, there they are. Palantir, it's got 50% of its revenue coming from the government, big contracts with the Department of Defense. That stock up 80% plus, one of the most bought and favorite stocks among retail investors, by the way. NRG Energy, they're a huge power company, especially in the Northeast, Southeast, using nuclear power, coal, all the stuff that the Trump administration has been favoring. That stock up 78%. And Howmet Aerospace, big defense contractor, obviously doing very well there. Seagate Technology, big cloud service provider, cloud service and data infrastructure. That stock's up 61%. Then GE Vernova, not your grandfather's GE anymore, folks. These folks, the folks at GE, now making much more industrial equipment and a lot more stuff for infrastructure building. And we know that's where the money's going to go. With the worst performing stocks, they got one or two things in common. One, maybe they rely a lot on imports like Deckers. Most of their clothing, most of their outdoor apparel coming from Vietnam, coming from China, coming from overseas in the Philippines. Centene, right in the middle of the healthcare issue. Why? Because they provide a lot of payments and services for government-backed healthcare, so-called Obamacare. That's not the sector you want to be in right now. This administration is trying to do away with that. Enphase Energy is one of the best performing stocks during the Biden administration. Big solar company, makes solar voltaic cells, makes big solar panels. Solar not in favor with this administration. Shouldn't be a surprise to see that trading off like that. And then United Healthcare has had problems top to bottom from the executive suite on down, but healthcare in a pretty tricky place right now. This administration hasn't touched it yet, but we know they're going to. And the Lululemon, well, where do they get their clothing? Vietnam, the Philippines, some from China. And if we're facing import tariffs from those countries, and that's where they get most of their apparel, well, that's what you can expect. And now silly stocks are back in style. Meme stock 2.0, the 2025 version, Open Door Technology. I talked about this a lot. I was on the Compound and Friends with Josh Brown and Michael Batnick last Friday, but this has a lot of momentum behind it. This is a technology real estate company, but it's got one big bull that's been pushing the stock, and he's got the attention of a lot of those folks on Wall Street Bets and the other chat boards. They're loving that stock up 372%. Big sell-off, though, last week on that. Kohl's, the retailer, 53%. GoPro, up 86%. The meme stock traders, especially on Wall Street Bets, especially on the forums, they're using these stocks like chew toys. So be very careful. SoFi, pretty good company, right in the middle of the student loan debate, but also this company is not necessarily a fly-by-night company. This is a real company, but the stock's been surging. Then Krispy Kreme donuts up 40%. Hey, it's not like we're eating more donuts, at least I'm not, but Krispy Kremes are delicious, especially right off the conveyor belt. But this stock's been soaring as well. Not a fundamental play. It's just one of those stocks that got into the meme stock cycle. That's why you're seeing that big rally. Be careful of those stocks. Those tend to fall pretty fast. Let's try to make sense of it all. We're going to bring in one of the smartest strategists I know, Cameron Dawson, the Chief Investment Officer of NewEdge Wealth. She's coming in the drop in just a couple of seconds. She's going to help us understand all of this. Oh, yeah. Cameron, welcome back to the Investopedia Express. So good to see you. Thanks for being here.
Thank you for being here. And I know you said it's not like we're eating more donuts, and I think you should speak for yourself on that one.
I will. And now I'm in the mood for some donuts. We should get a little sponsorship going here. Yeah, they do look delicious, especially when you see them coming right off the oven like that. There you go. Delicious B-roll. Cameron, you're a chief investment officer. You're a student of the markets and a great teacher of this for all of us. I learned so much from your weekly notes and also your appearances across financial media. As the CIO, how do you make sense of all of this melt up, so to speak? And we know that glaze was melting down, but how do you make sense of it?
Yeah, it's certainly important to come at it from two different angles. The first is exposure to the market overall and the beta of the market. And of course, we've seen this huge, massive rally since the April lows. But what we've been seeing is that a lot of investors have sat on the sidelines, mostly institutional investors. And we just got the Deutsche Bank Consolidated Positioning Report this morning of an update. And we just now finally, after a huge move, have gotten to a slightly overweight position, which just means that for the majority of the time of this rally, you had a lot of investors sitting on the sidelines. So that said to us is that the pain trade was still higher. And what we kept talking about with our clients is that the pain trade is higher if people are underinvested. Now, what that means though is that we have to be very clear about where we want to get our exposure in this market. And it's not just exposure for the next 1 month or 3 months, but how do we build exposure for the next couple of years? And we've certainly seen these low quality parts of the market rally and lead off of the low. But this is something that we wouldn't be chasing as long-term investors. It's not to say that you can't make money. It's not to say that these stocks can't keep going up. But if you look at the forward returns after you've seen moves like this, they typically are, to your earlier point, pretty abysmal, that they tend to round trip. They don't hold on to the gains. So it might be one of those classic, we're here for a good time, not for a long time kind of trades, but certainly not something that we would put in high quality, long-term client portfolios.
Yeah, and look, we this is nothing new. Every time we get sort of a melt up in general and a lot of enthusiasm in the market and anticipation of tariffs not as bad as we thought they might be, potential rate cuts, we know those will eventually come one way or the other. It's not crazy to see a rally in silly stocks, so to speak. Not that some of these aren't great companies, but when you see some of the moves, that's surprising. But you've also seen a lot of moves in high beta stocks in general, not just the meme stocks. You have a terrific note out this week called The Ministry of Silly Stocks in your weekly Edge column. We'll link to that in the show notes. But breadth in general, as I mentioned, pretty good when you look across sectors, especially where we were in early April, right?
Yeah, certainly. You've now gotten to a point where you have about 74% of the S&P 500 companies are above their 50-day moving average. So there's been good participation. One thing to note is that if we look at the number of stocks making new 52-week highs, it's only about 9%, and only about 12% of the index is at new 20-day highs. So we'd really like to see those new highs expand. It would definitely give an indication that there are legs to this rally, but it's not necessarily a death knell to say you can't keep moving higher. Now, we would note that in the very short term, the market is certainly overbought. If you're just looking at something simple like the RSI, if you look at something like the MACD, moving average convergence divergence, you've seen some of the momentum stall out a little bit, at least on the daily charts. So that just suggests that as we go into the August timeframe, where we typically do see a seasonality with volatility tends to pick up, and we start to get into a tougher seasonal stretch over the next few months for the markets in general for returns. That just suggests that maybe this melt up where we make new highs a day in and day out, maybe that takes a little bit of a breather. Nothing cataclysmic, but certainly wouldn't be too surprised to see some digestion.
Yeah, well, good tease to a segment we're going to talk about later, which is volatility, which has been super quiet. It's like we're in some summer nap here, yet the news headlines have been really loud. It has been one of the loudest, busiest news summers that I can remember in my entire career, but the market's just churning higher. We haven't had a move beyond 1% in 21 days, and that seems pretty unusual. But as I said earlier, the trend is your friend. Do you worry about sort of the lack of noise in the market, or is this what you want to see in a healthy trend?
Yeah, you do worry somewhat. I have a book behind me called Why Minsky Matters. And Minsky moment, of course, is this idea that conditions of low volatility create the conditions for high volatility, meaning that low volatility tends to create complacency. People take on too much leverage. They get overexposed to the market. They take on too much risk. And then, boom, something happens that nobody was expecting. And that's when you get your higher volatility period. So, wouldn't be all too too surprised, mostly given the degree of leverage we've seen added to this market. You look at FINRA margin loan balances, they're up about 20% in the last couple of months. You can also see it through the options market. So you have call option volume as a percentage of total option volume at its highest level since 2021. Of course, put options on the other side, people paying for downside protection, are at their lowest level since 2021. So that would suggest that this market certainly is only expecting good news. And when you only expect good news, it creates a high bar to surprise to the upside.
Yeah, everyone's leaning on this side of the boat. When people start leaning that side, things get a little topsy turvy. Let's talk about the yield curve. Let's talk about the treasuries in general. Look, it's compared to a year ago, we have some elevated yields. And is that concern, especially on the long side of the treasury market, is that just a reflection of the concern about this economy maybe look okay right now, and the tariffs were maybe more smoke than fire, not as bad as we thought they were. But long term, when you look at all the spending, when you look at the passage of the tax bill, when you look at this massive deficit and all the money we have to pay to service it, you think that's what this is reflecting when you look at the treasury yield curve today versus a year ago?
Yeah, there's a couple important points here. The first one is this premise of what we've been calling the zoo steepener for the last year or so. This idea that you get a bull steepener on the front end. So that means that yields are falling as bond prices are rising. So it's a bull steepener on the front end, but a bear steepener on the back end, meaning that long end yields are rising. So you get the bulls, the bears, thus you're in the zoo. And the problem or the challenge with this is that as you see short end yields fall, you are effectively cutting cash interest income to consumers. You have consumers who have been enjoying $7 trillion balances in money markets that are clipping these huge coupons. It's been one of the reasons why consumption has remained so strong, that even as rate hikes happened, you didn't see it impact consumption in a way that was negative. In fact, in some pockets of the economy, rate hikes were actually positive. But then as you see the long end of the yield curve move higher, that of course continues to hurt the housing market, and why we see housing data stay absolutely abysmal. And it's such a good reminder as we are talking about the potential for rate cuts, is that the Fed really controls the front end of the yield curve, and they don't control as much the back end of the yield curve. It's more driven by supply and demand. Now, the Fed can influence the back end through things like quantitative easing to the downside or quantitative tightening to the upside. But if the Fed cuts interest rates, let's say 100 basis points over the next 12 months, it's a really good question what happens to the back end of the curve. And could we actually see the back end of the curve move higher like it did during the last 100 basis points of cuts last year? And that certainly would be an interesting dynamic for the economy. We think it actually overall weigh on growth and not be as stimulative as people might be expecting. So a very classic, be careful what you wish for.
Yeah. Well, we love Zeus Deep, and we're going to have to put that into the Investopedia lexicon if it's not there already. So, last question
Can
then.
it be
We're
in?
actually
That would be amazing.
absolutely, and you're going to get your name all over that one. So, when you talk about rate cuts, and everyone's been anticipating, the president's demanding, we got a Fed meeting this week. We know he was over at the Fed offices last week with the hard hat, giving the Fed chair a hard time about the renovations. But these rate cuts actually matter, or investment chief investment officers like you and strategists are already assuming that this is going to happen one way or the other. So why are we spending so much time worrying about it?
Yeah, it's a good point because it's really a matter of timing. If you look at the number of rate cuts that have been priced in going back to April, May timeframe to today, it's effectively been stagnant. And the 2 year yield has been stagnant. And for that matter, the 10-year yield has been stagnant. So for all of our hemming and hawing about when rate cuts are going to come and what's growth going to be and what deficits are going to be, you've just seen this sort of static trading of yields and sort of oscillating in a pretty tight band. So we think that our view on the Fed has been one where we think the Fed needs a reason to deliver rate cuts because of inflation uncertainty. And that reason needs to be a deterioration within the labor market that is more meaningful than anything that we have seen. So our view has been, if we see some labor market weakness, the Fed is definitely cutting because they have the air cover to say that we are above neutral, so we will cut down to neutral. But you're still in an inflation environment environment where we're expected to get core PCE this week coming in at 2.7%. It's a bit of a precarious position when you have still a fairly low unemployment rate to be delivering rate cuts. We always talk about the idea of the ghost of Arthur Burns haunting the Fed, the idea that they cut rates too much and that we go back to this stop start policy environment that we had in the 1970s. But I'd like to add another ghost to that, which is the ghost of Alan Greenspan in the 1990s, in the late 90s. And of course, in 97, he warned about irrational exuberance. In 1998, they cut rates 3 times. And by the time they cut rates for the third time, the Nasdaq was already back to an all-time high, and then followed by going parabolic for the next year and a half. And that ended up being destabilizing for the next decade or so because you had such a big bubble. So it would be very interesting to see them deliver as many rate cuts as people are expecting, given that equity markets are at highs, credit markets are at tights, financial conditions overall are still pretty easy. And so it raises the question of why so fast?
Yeah. Yep. And are you not entertained with all these higher highs? Let's go out on this. And again, you're such a great teacher and student of the markets. I love the historical references. Where are you finding opportunity now for your clients outside of this melt up in the US equity markets in particular?
Certainly, we found a lot of opportunity within mid cap names over this year, which is where we're finally starting to see a little bit activity down cap size as that breadth has improved. We stick to quality, so in times like this is of course where you see some of the most shorted, lowest quality parts of the market do well. But we'll stick to our knitting on the quality side of things. We're also finding a lot of opportunities outside of traditional equity and credit markets or fixed income markets. We've been doing a lot of work on infrastructure. We think it's a great thing in overall portfolios for that portfolio construction to have something that's stable, less correlated to the Fed or the equity markets, and provides an overall attractive return.
So good. Thank you so much for the great insight, folks. Follow Cameron at the Cameron Dawson and the Weekly Edge from her and her partners at NewEdge Wealth. Cameron Dawson, the Chief Investment Officer at NewEdge. Thanks so much for joining us. Great to have you back on the Express.
Thanks.
All right, let's do a little money in motion right now. We've been talking about shorts. We've been talking about short interest. Let's get into it with a little money in motion, Santa Fe style. Well, you heard Cameron and I talking about shorts. You heard us talking about meme stocks, silly stocks. And guess what? Stocks that have had some of the biggest rallies, especially in the last month or two, these are also some of the most shorted stocks in the market. UBS keeps an index on this chart here from Bespoke of 100 heavily shorted stocks, and the basket since the relaxation of tariffs post Liberation Day on April 8th, this group of stocks is up 79% just in the last 3+ months. There's another basket of 50+ stocks, and I believe that's a blue line there. Those are heavily owned by hedge funds. That's up less than half of that at 37%. 37%. The S&P 500 up 28%. What's the lesson? It may be summer, it may be 100 degrees out there, but be careful if you're trying to trade in shorts. I know it's tempting. I know Wall Street bets, and I know a lot of the day trading crowd and the meme stock crowd want you to jump into the stocks that are most heavily shorted by the hedge funds and stick a finger in their eye like they did back in 2021 with GameStop and AMC and BlackBerry. And those trades can be fun for a little while, but the bottom falls out real fast. And usually, most of us that try to pile into those stocks are late getting in and late getting out. And the lesson is when you look at, again, these stocks that have the biggest shorts, you've got to be very careful. Earlier, we showed you a chart of the best performing stocks in the market so far this year. Well, guess what? A lot of those stocks, and these are quality stocks, these are also some of the most heavily shorted. So we've seen a big rally in a lot of these, and some for good reason. As I mentioned, they're on the right side of policy, and they are on the right side of this administration. And believe me, if you're a public company right now, you don't want to be on the wrong side. We've seen it, what can happen if you're not. A lot of these are also heavily shorted. So be very careful trying to chase these rallies. Might be easier just to sit back and watch the indexes play out because we're just getting higher highs across the market right now. You could chase, but do it with a very small percentage of your portfolio and make sure you have rules to get out. All right, so much going on this week. Let's get a look at both the Investopedia indicator and what to watch in this very, very busy week ahead. I hear a train a coming. It's coming down the tracks, and that train is the Santa Fe Railroad running by me right outside here, outside my windows. But we got a huge, busy week ahead. Tons of earnings this week. We are in the meat of earnings season this week. Investopedia has a great preview on what to expect this week. Let's go through the calendar real quick. Today, earnings from Waste Management and Cadence Design Systems. We already had news overnight of the trade deal between Europe and the United States. That's sending markets higher in Monday morning trading. Going on to Tuesday, the U.S. trade balance. We'll get a sense of how some of this tariff negotiations played out in the month of June to see if that trade balance between the U.S. and its partners, trading partners, actually reduced a little bit. We'll get the JOLTS report. That's a job openings labor turnover survey. It's a busy jobs week that precedes private payrolls, precedes weekly unemployment, and then Friday we get the jobs report. But big earnings on Tuesday from Visa, Procter & Gamble, United Health Group, Merck, Boeing, Starbucks, UPS, and many, many others. And then Wednesday, the big FOMC decision on interest rates. If you look at the CME Fed Watch tool, which I like to look at almost every single day, there's a less than 2% chance the Fed cuts rates at that meeting. There's a 100% plus chance the president will be very upset about that and say mean things about Fed Chair Powell. We'll wait and we see how he reacts to that. He's been pretty sanguine about it. GDP for the second quarter comes in, another reading on that. Earnings for Microsoft, Meta, Robinhood, Carvana, Ford, some of the busiest, most actively traded stocks in the market Thursday. As Cameron mentioned, PCE, the Fed's preferred gauge of inflation, the Personal Consumption Expenditures Index, and then earnings from Apple, Amazon, and others. And then Friday, August 1st, the big tariff deadline. We may get some deals before that. We still haven't heard from Canada. We still haven't heard from Mexico, but we're also going to get the jobs report for July out on Friday. We'll see if the unemployment rate holds at 4.1%, plus a reading on consumer sentiment and even more earnings. Exxon, Chevron, Clorox, so many companies reporting results this week. And as we've talked about before, earnings are better than expected. They usually are. Companies have a way of massaging their earnings to make sure that those profits always beat expectations. We want to look at things like margins. We want to look at their outlooks going forward. As those tariff negotiations continue and there are less bad, less onerous as expected, going to see companies opening up a little bit. Delta was already giving us a better forecast. United giving us better forecasts. We've heard from the banks. They say things are going to get better. We'll see if that actually plays out. And we're going to be listening closely to the outlook from these companies as they report results this week. And follow Investopedia.com because our news team is all over this coverage. All right, let's get into the Investopedia indicator of the week. And we teased it a little bit in our conversation with Cameron Dawson of NewEdge Wealth, but this has been a pretty quiet rally, churning higher and up and to the right. The news headlines have been loud, really loud, but the VIX, the volatility index, which measures volatility through the options market, Cameron mentioned it, not so many puts, not so many bets against the market, which would give you a higher reading on the volatility index. Most people betting on higher highs for the market through call options. You get low volatility. And the VIX, the volatility index, or the fear index, has been pretty quiet. It's taken a summer nap while all these headlines have been so loud around us. Let's take a look at this chart of just the VIX over the last 21 days. We haven't had a move in the stock market above 1%. You see how quiet it is on the chart there on the lower right there. And April, you saw it screaming like a toddler in a toy store when it's time to go home. Right around Liberation Day, it's quieted down quite a bit since then. So when there's low volatility, usually you see the market kind of churning higher, quietly up and to the right. And that's exactly what we've seen. We haven't had a move beyond 1% in the S&P 500 in over 20 days. And when that's happening, usually things are churning up and to the right. And that's exactly what's been happening. That could change at any minute. We could have news headlines or an announcement from the White House or anything that could change that mood. But right now, when the trend is your friend, low volatility, good breadth across the stock market as an investor, despite everything else that's going on, that's kind of what you're looking for. And that's kind of what we're getting right now. So a lot going on this week. Make sure you are checking in on Investopedia.com. Our folks are covering the news that matters most to educated investors like you and me. It's going to be busy, so I recommend wearing a hard hat, especially if you're the Fed chair. He has one on right there, and I'll probably throw on a helmet, go for a bike ride sometime real soon. From Santa Fe, New Mexico, to you, wherever you're listening, we'll talk. Hey, Sarah. This is so cool and helpful. Thank you for joining the Investopedia Express. We're here every Monday at 10 a.m., but on demand on your favorite podcast network. Sambu, hello to you. The trend is your friend, Max Dio, and so are we here at Investopedia. Thanks so much for spending your Monday morning with us. We hope wherever you are investing intelligently. And Polito, this is awesome news, and we hope the news stays awesome, especially wherever you are right now. Thanks so much for joining us. We love the comments. Keep them coming. There it is, the Santa Fe Railroad. From Santa Fe, New Mexico, high up here in the Sangre de Cristo Mountains to wherever you are. Thanks so much for joining us, and we'll talk again a little further on down the line.